The reason the yield curve has such strong predictive power is that it reflects the interaction of two major forces: central bank policy and market expectations. Short-term interest rates are largely influenced by central bank policy rates. When central banks raise interest rates in order to control inflation, short-term government bond yields usually rise quickly because those instruments are closely linked to policy rates. Long-term yields, however, are more influenced by investors' expectations about future economic growth and inflation. If investors believe that the economy will remain strong and inflation may persist, long-term yields tend to move higher, as investors demand greater compensation for holding bonds over extended periods. But when markets begin to fear an economic slowdown or recession, investors often shift their portfolios toward long-term government bonds as a safe haven. This increased demand pushes bond prices higher and yields lower, causing the yield curve to flatten or even invert. Historical data illustrates this pattern clearly. In the United States, yield curve inversions have frequently appeared roughly 1 year before economic recessions. Before the collapse of the dot-com bubble in 2000, ahead of the global financial crisis in 2008, and again prior to the economic shock of 2020, the spread between 2-year and 10-year Treasury yields turned negative. Of course, the yield curve is not a perfect forecasting tool. Central bank asset purchases, quantitative easing, and global capital flows can all influence long-term yields and distort the shape of the curve. Nevertheless, the yield curve remains one of the most closely watched macro signals in financial markets. It reflects not only the structure of interest rates, but also the collective judgment of investors about the future economic cycle. For this reason, whenever economic uncertainty rises, investors often look first at changes in the yield curve to assess whether the market is beginning to reprice the next phase of the economic cycle.